What are my three key charts on the macroeconomy right now? Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial. And in this edition of the Econ Market Minute, I want to share three of my top charts, which include a snapshot on the household debt burden, hiring trends, and a teaser for the missing link between wages and inflation. First, the job market points to a soft landing. Excluding the blowout report for January, average job gains were on a smooth downward trajectory. Minimal turbulence in the trend line, and we would definitely call that a pathway to a smooth landing. In fact, in my view, the blowout jobs report did not alter the Fed's playbook. Unemployment rate was 3.4% as the labor market is still very tight, too tight for central bankers. But more importantly, growth in average hourly earnings continue to slow, easing down to 4.4 year over year. Low participation rates continue to weigh on the markets, but it's important to remember that business formation stats are consistently growing above pre-pandemic levels, revealing many workers' interests for alternative employment and could explain some of the workers still out of the official labor force. So bottom line here, the labor market is still solid, offsetting some risk of slower consumer spending. Additionally, the slowdown in average hourly earnings should ease inflationary pressures in the near term as wage growth comes back in line. No doubt, the Fed will continue to increase rates at the next meeting to slow down the demand side of the economy. This second chart highlights that consumers hold much less debt now relative to previous cycles. After the great financial crisis, consumers started aggressively deleveraging. Overall debt payments as a percentage of disposable income declined and remained steady until the emergence of COVID-19. And most recently, the debt service burden on the American household moved back up to pre-pandemic levels, but still relatively low. The job market is tight, which means that personal income growth is supporting consumer spending along with the accumulated excess savings. To further pad personal spending, consumers will likely tap into consumer credit. We expect revolving credit demand to increase in the first of this year, but we don't expect debt service payments to approach those levels in 2007 and 2008. My third pick highlights the inflation and wage dynamic. Especially now, it's important to remember at least two facts here. First is core services inflation ex housing can slow down fairly quickly. Look what happened in the mid and late 1990s. The sticky services inflation eased considerably, and that was even during years of rising wages and salaries. The second fact is productivity gains is the important missing link between rising wages and falling sticky inflation. The scenario can play out in 2023 if we see healthy gains in productivity. And we know that recent layoff announcements were mostly tied to business efficiency gains and cost cutting. So I think we should expect productivity to improve in 2023. Well, that's all for now. Continue to follow me and the LPL research team on social media, and take care.